I'm a big hockey guy, and I often hear the analogy in hockey, best offense is a good defense. And yet nobody ever talks about that in investing. I believe it should apply, and I'm gonna tell you how in this video. I'm Rob Tatro, guys, and I've always believed that some of the most valuable hockey players on a team are those two-way defensive specialists that often contribute also offensively. You know, I'm thinking of the Guy Carboneaus and Bob Gainey's and Patrice Bergerons of the world. And yes, I'm dating myself a little bit with some of the older references, but those are guys that back in the day would step up, they'd block shots, they'd protect their defense, they'd protect their goal as best they can, and they would also contribute offensively. They'd do the small things, they'd win faceoffs, you know, they'd kill penalties, and those were the key players, create turnovers, valuable assets for a hockey team. In investments, we're always talking about absolute total return. You always hear people saying, I made 23% last year, I made 35% last year, and yet you never hear people talk about their returns in negative years or in negative markets. My belief is that there's a lot more protection and value add that can happen in a negative market with retail clients' portfolios like yourselves than in any other market. And that's where we shine. I'm going to tell you how we do it. So first off, if you just owned, stock, you would move up and down in your portfolio along with the market, right? You'd have good years of plus 40 and bad years of minus 30 or 40. You'd get used to it perhaps, or maybe you wouldn't. Maybe you enjoy that experience, maybe you don't. But regardless, for most people, that's not a fun experience to be minus 30 or minus 40% in their portfolio. And it's also very tough to get back, because let's assume you have $1 and you lose 40%, right? So you go down to 60 cents. Now you're at 60 cents. To get back to your dollar, you don't have to do a 40% return. You need to generate 66% return to go from 60 cents to $1, right? You need to generate 40 cents of return on 60 cents. So someone who loses 40%, gains 40%, loses 40%, gains 40% is going to get killed in the market. Volatility is bad for portfolios. It's bad for returns, but it's also very bad for the mental side, right? And that matters. Your emotions matter. You matter. Your health, how you feel at night thinking about your portfolio, maybe you're not, maybe you are, but how you feel, that matters. That's an important thing. What I've realized is that Canadians much prefer portfolios that are a lot more stable. They generate income kind of regardless of what happens in the market, and they love investments that are a lot more agnostic to what happens globally. In addition to outperforming traditional portfolios, it's actually a lot easier on the client to stomach. So I'm going to tell you guys how we do that right here in this video. First off, we don't put all of our eggs in that same basket, the basket of stocks or the basket of bonds. Now, why is that the case? Well, the idea of diversification, used to be you put some in stocks and some in bonds, and if ever bonds went down, well, stocks would go up. And if ever stocks went down, bonds would go up, and therefore you'd be protected, you'd be diversified. But in reality, what's happened over the last 20 years is that they both move up and they both move down. So you have really bad years where stocks and bonds are down, and your balanced portfolio that should be pretty defensive gets hammered to the tune of 14% or something like that. And you're sitting there thinking, I thought I was balanced. Why am I down so much? Why is this so difficult? It's because all those eggs really are in a similar basket. It's equities or fixed income that's trading on a market, and that's dealing with the emotional cycle of what we're going through. So when you're upset, or if someone's upset about their portfolio and they decide to sell everything, which is what happens when the stock market corrects, right? So people say, I'm gonna sell everything. I'm upset about the portfolio. I'm upset about the stock market. I'm selling everything. They call their advisor, they sell everything. They don't just sell the stock, they sell the stocks and the bonds. So what happens when markets are bad because of something that's happening, a recession, a global crisis, a pandemic, when something bad is happening, all of those asset classes fall, right? So how do we protect against that? Well, we need to do real diversification, not just stocks and bonds, real diversification. This means assets and asset classes that don't move the same way that stocks and bonds move. I like to call these alternative assets, all right? So these are typically real assets. So think of multifamily rentals, like apartments, condos, townhouses. You own those properties, people are living in them, they're paying rent, you collect the rent, you pay down the mortgage, and you own that asset class. Real estate appreciates in value. You know people that have owned real estate, you know people that have made a ton of money in real estate. You should own some real estate in your investment portfolio. You should. Farmland, right? Farmers that have made a ton of money for sure. We own the asset class, right? No operational risk, you own the asset class. Asset class appreciates over time. There is no big crash when something happens in China or there's a war in Ukraine. There's no real crash on that asset class because nothing fundamentally changes. The valuation remains the same. So that means month over month, there's no change in the value of your ownership in that farmland private holding. All right, so last month it might have been $1,000. This month it's still $1,000, and maybe next month it's $1,001. Right? It slowly appreciates over time. There are other real asset classes: infrastructure, right? Storage units, private equity, music royalties. Music royalties is a great one because it's completely uncorrelated to the stock market, right? The streaming revenue that's generated every time you and I listen to a music, whether it's on our Peloton or our PS5 or just on our phone, revenue is generated from that, which gets sent to the owner of those royalties, to the owner of that catalog of songs. Does it matter what's happening with the stock market? Are we streaming more or less music if the stock market's up or down? No, right? It's completely irrelevant. Therefore, you're getting that income, and the book of catalog of songs is slowly appreciating in value. Those are truly uncorrelated stocks. Those are the face-off winners. Those are the shot blockers. Those are the takeaway specialists of your portfolio. They're protecting your portfolio against goals in the back end, right? They're defending your portfolio, because what happens is when the goalie's not on his game and the stock markets are getting hammered, you have these asset classes that are keeping their value. So stocks are down 30%. Our alternative portfolio is up 10 or 8 or 7. It continues to keep its value. It appreciates a little bit. It pays nice distribution. It's a phenomenal defender of your portfolio. These uncorrelated assets, in addition to being extremely tax efficient, are a great way to protect your portfolio so that in years where the market's getting killed, that year that you were minus 14, yeah, my clients were probably flat. So instead of being at 86 cents to start the day, they're at $1. And then the following year, when the markets are up and their alternatives are up, yeah, they're at $1.10 or $1.15, whereby you're just trying to get back to par. So protecting that portfolio is critical. That's why my love for those defensive hockey players, that's the kind of player I was when I was growing up, a defensive specialist. I was never really that good at hockey, but I liked playing and I liked filling my role. My role was to be a defensive specialist. These alternatives have that same role. They're good at it, and you should own some in your portfolio. If you don't own some, or you don't think you own some, go to speaktorob.com to book your no obligation consultation. I'd love to chat with you about this or anything else in your portfolio, because it's time for you to be defensive. You don't need that big correction in your portfolio every time the market has a setback. Thanks for tuning in, guys. We'll see you in the next video.